Climate finance and green investments are pivotal in addressing the global climate crisis. With rising temperatures, severe weather events, and increasing environmental degradation, transitioning to a sustainable economy has become an urgent priority. The financial sector plays a critical role in this transition by mobilizing resources to fund projects that mitigate climate change and foster sustainable development. The scope of climate finance is vast. It encompasses funding for renewable energy projects, sustainable infrastructure, energy efficiency, carbon capture technologies, and conservation efforts. According to the Climate Policy Initiative, global climate finance reached $632 billion in 2020, but this is far short of the trillions needed annually to meet the goals of the Paris Agreement. Bridging this gap requires innovative financial instruments, policy support, and public-private collaboration. Green bonds are among the most significant financial tools in climate finance. These are fixed-income securities designed to raise funds for environmental projects. The global green bond market exceeded $500 billion in issuance in 2021, with countries like the United States, China, and the European Union leading the charge. Investors are increasingly drawn to green bonds because they offer a way to support sustainable initiatives while earning returns. However, transparency and accountability in green bond projects are critical to avoid greenwashing, the practice of falsely portraying investments as environmentally friendly. The role of central banks and financial regulators in green finance is evolving. Many institutions now integrate climate risks into their financial stability assessments. The Network for Greening the Financial System, NGFS, a group of central banks and supervisors, advocates for incorporating climate-related risks into monetary policy frameworks. The European Central Bank, ECB, for example, has committed to aligning its monetary policy operations with the goals of the Paris Agreement, including adjusting its corporate bond purchases to favor companies with stronger climate performance. Sustainable investing is another cornerstone of green finance. Environmental, social, and governance (ESG) criteria are increasingly used by investors to evaluate companies. According to Morningstar, global ESG fund assets surpassed $2.7 trillion by the end of 2022. ESG-focused funds prioritize investments in companies with strong environmental practices, sound governance, and positive social impacts. However, the lack of standardized ESG metrics poses challenges. Different rating agencies often provide conflicting scores for the same company, creating confusion for investors. Efforts to standardize ESG disclosures, such as the Sustainability Accounting Standards Board (SASB) framework and the EU Sustainable Finance Disclosure Regulation (SFDR), are gaining momentum. Climate finance also intersects with development finance. Developing countries are disproportionately affected by climate change despite contributing the least to global emissions. The United Nations estimates that developing nations need $5.80 to $5.9 trillion annually by 2030 to achieve the Sustainable Development Goals, SDGs, including climate-related targets. International climate finance commitments, such as the $100 billion per year pledge made by developed countries, are critical but have fallen short. According to the OECD, only $83.3 billion was mobilized in 2020. Private sector engagement is crucial in scaling climate finance. Major financial institutions, asset managers, and corporations are increasingly pledging to align their portfolios with net zero emissions targets. Initiatives like the Glasgow Financial Alliance for Net Zero, GFANZ, bring together financial institutions committed to transitioning to a low-carbon economy. However, translating pledges into concrete action requires clear strategies, measurable goals, and transparent reporting. Technological innovation is transforming green investments. Advances in renewable energy, electric vehicles, energy storage, and sustainable agriculture present vast investment opportunities. The International Renewable Energy Agency, IRENA, projects that global investments in renewable energy need to reach $131 trillion by 2050 to achieve carbon neutrality. Venture capital and private equity are pouring funds into climate tech startups developing solutions for carbon capture, alternative proteins, and smart grids. Policy frameworks and regulatory support are vital for fostering green finance. Carbon pricing mechanisms, such as carbon taxes and cap-and-trade systems, incentivize companies to reduce emissions. According to the World Bank, over 60 carbon pricing initiatives are implemented or scheduled globally, covering about 20% of global greenhouse gas emissions. However, carbon prices remain too low to drive significant change in many regions. Policymakers must strike a balance between ambitious climate policies and economic considerations to avoid undue burdens on industries and consumers. International cooperation is key to scaling climate finance. Multilateral development banks, MDBs, such as the World Bank and the Asian Development Bank, play a vital role in providing concessional finance for green projects in developing countries. Additionally, climate finance mechanisms under the United Nations Framework Convention on Climate Change, UNFCCC, like the Green Climate Fund, GCF, aim to channel resources to climate adaptation and mitigation projects. Strengthening these institutions and ensuring equitable access to finance for vulnerable countries are essential steps. Climate finance also influences corporate strategy and innovation. Companies increasingly recognize that integrating sustainability into their business models is not only a social responsibility but also a competitive advantage. Transitioning to circular economies, adopting sustainable supply chain practices, and investing in clean technologies can drive long-term value creation. Shareholder activism and consumer demand for sustainable products further accelerate corporate commitments to climate action. Risk management is central to green investments. Climate change poses physical risks, such as extreme weather events damaging assets, and transition risks, including regulatory changes that affect business models. Financial institutions must enhance their climate risk assessment capabilities. The Task Force on Climate-Related Financial Disclosures, TCFD, provides guidelines for companies to disclose climate-related risks and opportunities, helping investors make informed decisions. The growing adoption of TCFD recommendations reflects the increasing importance of integrating climate considerations into financial decision-making. In conclusion, climate finance and green investments are indispensable for building a sustainable future. While progress is being made, scaling these efforts requires a holistic approach involving public and private sectors, technological innovation, regulatory support, and international collaboration. By channeling capital into sustainable projects and integrating climate risks into financial systems, we can create a resilient, low-carbon global economy that benefits both people and the planet.